Friday. It is April 5th, 14th. Wow. I'm already living in the future. I hope everybody's having a good day. We're going to kick this off. We are back at we've erased all of our pre-war losses. So we're going to explain why we are back near all-time highs this morning, just trying to make sense of this market. There are 7 or 8 reasons. And we're going to walk through each one of them today so that you have a little bit of an understanding of what has happened with momentum in this market, particularly with equities bouncing back the way that they have since March 30th. But yes, again, the S&P 500 has erased all of those pre-war losses, and we can just take a very quick look at the good old SPY, the deadest cat bounces, or an actual rally and a move as Yardeni has predicted toward that 7,200 level. I'm going to advise you now, if you take a look at this chart, keep a very close eye on the RSI. That is the relative strength index. It is the oversold indicator, overbought, oversold above 70. It is a price momentum oscillator. And what we tend to see is when we get into that 70 level, that's where some profit taking comes. Now, a couple of moving parts. We do have the Treasury General account kind of stuffed to the brim. But a number of other things are driving this bus, and I'm going to walk you through it. I will note that we went positive on our cap weighting for momentum on the 6th of April, and you could see that the cap weight has taken us much higher. That is the biggest stocks in the S&P 500 doing the bulk of the work. Technology has been positive since 2 Mondays ago. The market shifted, and this is one of the reasons why we have this indicator. We can see, obviously, that the Russell has been on fire as well. The Russell pushing into positive territory back on April 6th as well. So that was last Monday, and it came very quickly, and there are reasons for this. This is one of the things that I have to remind myself, no matter how many times I do this. I was bearish. I was pushing against the market. I was seeing a lot of negative things, but the signal seems to know all. This is simple math. This is the number of stocks breaking out versus breaking down based on their sector. It is a positive versus negative figure. And when it goes positive, you got to be positive. That's the point of the line, right? Stay positive. So right now, we continue to move higher. We're going to talk about why. There's 8 reasons. All right. Real quick before we get started, before the bell, PPI numbers coming out relatively soon. That's wholesale inflation. No, it's not. It's not wholesale. It's front end. Wanted to make a point on this. Key thing here, very important to note. It's not wholesale numbers. PPI numbers, the origination of crude in Louisiana has nothing to do with end prices in Europe. Wholesale is wrong. This has not been a wholesale indicator since 1978. So you tell everybody. JP Morgan reporting 594 versus a 543 estimate. That's a beat, but guidance cut by 1.5 billion. Wells Fargo NII was below street, down 2% in pre-market. J&J, Citigroup, BlackRock due today. We'll talk a little bit. It's a busy week for the banks, of course. It is earnings season coming off at the back of, guess what they did? They printed money. Monday's open. We're at 69.35. NASDAQ at 25,600. The Russell nearing 2,700. And the VIX is now under 20. Yeah. They're printing money. I don't know how I can explain it anymore. So how are we at all-time highs? Well, once again, these returns, these bounces, these rebound rallies that we see are very fast. These are not markets that tend to recover slowly. That is what happens on the backside of a liquidity cycle. But we can go back and we can look at that period of time back in November where Japan had to print to $117 billion. Quick V-shaped recovery. We saw this happen in April. Quick V-shaped recovery. Same thing happened during the Nikkei crash. Quick V-shaped recovery. It happens fast. And I remind you constantly, I tell everybody, watch the 20-day moving average. I can't stress enough how important the 20-day moving average is for momentum, for buying algos, for just optimism to return. So the first thing is a momentum-driven rally heavy out of, you guessed it, oversold on the RSI. We pushed toward oversold on MFI. We didn't quite get there, but we were oversold on the RSI. And as we know, going back to Druckenmiller, the algos like to buy out of oversold. The Fed is printing money. I don't know how to stress this anymore. Lynn Alden has called this the gradual print, $40 billion a month to start the year. They printed somewhere in the $212 billion range. Now, they're not going to call it money printing, and they're not going to call it quantitative easing, but it is fiscal repression. And they are effectively purchasing short-term treasury bills to keep the borrowing costs low, and they're borrowing more than they know what to do with almost. I mean, I'm looking at a report from Peter G. Peterson Foundation showcasing that bills have recently increased as a share of total borrowing. That's down here, number 7. And the number of bills, right? The percentage of bills as a part of U.S. borrowing is now roughly at high levels we haven't seen since COVID. So they're engaging in short-term borrowing using treasury bills under 12 months, and then they refinance them. And it's important to note, these are cash-like instruments. This is how leverage builds. This is what's used in repo. These are the best collateral in the world, and that collateral is utilized and finds its way into equities. All right, so you have that. You have reserve management, and this is important. I wrote about it yesterday. It was at $40 billion a month, but as we look at what the banks expect, the banks are now anticipating somewhere between 10 and 25 billion in continuation of this program. They were doing this to shore up the reserves in the banking system ahead of tax season. They probably just said it was because of tax season, because this is going to keep going. So the possibility of another 15 to 25 billion a month into who knows how long. And this is kind of a slow drip of liquidity support, and it's monetary expansion. By any other definition, the Fed balance sheet is going up. So the combination of borrowing its short-term bills and then the Fed buying the bills as well, again, this is positive for equity markets. The next thing I do want to note, there is an error in the energy markets, and I'm seeing this more and more as I talk to international energy experts and analysts. Had a conversation with one in Switzerland yesterday, and it was that the blockade coinciding with the Saudi East-West pipeline now moving toward near total capacity of 7 million barrels. When the war started, it was only 750,000 barrels a day, and they didn't know how long it was going to take. Now it's flowing. So this is working very well, and the blockade is in existence, but roughly, I'm seeing estimates somewhere in the range of 15 to 17 million barrels per day are still getting out. And that's important to note. Analysts have been saying that these pre-war barrels are accounted for. Tankers are moving to the Gulf of Mexico as well. So you're not getting to that 140, 150 level. You're not getting to that 200 level. It would need a bigger geopolitical event, and it's not happening. And right now, WTI and Brent crude have dropped back under $100. And I've continued to stress the OILU. The OILU, which is the triple bull leveraged ETN, that's where the leverage is. It's evident in the sector. It is under its 20, and it's under its 8-day EMA, and it's trending lower. And now the question is, how much lower does oil go if and when this is resolved? And some of the most bearish people in the world go back to the banks. You start to revisit prices that may be down at levels where we were before the war actually started. So again, keep an eye on the OILU. If you're trying to go long on Devon or Oxy or any of these names, you want to see a continuation of momentum. And this really does a good job at tracking both the upstream and the downstream of the energy sector. The dollar is down. This is important. Remember, we've talked about dollar shortages. This has been alleviated in a pretty unbelievable fashion. But we're now under 98 on the DXY. That's important, right? So there is access to cash. That squeeze that we saw has dissipated. Now, it's not permanent, but you could see it in the gold prices. You could see it in the silver prices. You could see that capital is continuing to rotate back into these metals, and you don't have countries selling tons and tons of gold to raise dollars to then purchase oil. So this is an important element to keep in mind. The VIX is at 19. Yikes. Meanwhile, capital weight flows. And I go back to what we discussed. This is the capital wave number. This is our momentum index. And this momentum index, very surprisingly, went positive on April 6th. Now, again, I'm doing the autopsy of this. I'm going back and I'm reassessing and wondering how and why this occurred. And it goes back to quarterly rotations. It goes back to coming out of oversold. And the one thing that I do want to note is momentum is heavily cap weighted. So the top stocks, those big banks, those big tech companies, they pulled this market higher, even though we had an equal weight number that lagged in the process. So this pulling the market higher on the Russell, same thing happening on the S&P 500. I have it backward, but I apologize. But you could see the S&P 500 got pulled, and the Russell has just been pure momentum for the last for the last week and a half. So follow the signal, pay attention, and ride that wave. It's very, very difficult to short, but you can see once again in the TNA, which is the triple bull ETF around the Russell, what happened? It broke above its 20-day moving average on April 6th and April 7th. That's very important. What happened with the FNGD? The FNGD broke under its 20-day moving average and stayed there after April 6th, April 7th. Leverage is rebuilding. So these things are important. This coincided with rotation. We did see an uptick in insider buying on the number of filings, but not in a dollar to dollar level. That said, filings can be considered a little bit bullish, but not the signal I was looking for, and certainly not the policy change that I was looking for. However, once again, the Fed is providing monetary support, and this market is continuing to charge higher. That said, I still do view exactly what we noted about the hedge of tomorrow, that we are in this late cycle period. These squeezes can and will happen. And I want to note, we go back and we analyze and we assess what happened in 2022. The last time we were in this cycle, it was a process of lower highs and lower lows. And we did have big squeezes that happened. And we did push back toward near all-time highs. But at the end of the day, the point is, they are engaging in monetary support. They are expected to allow that to abate heading into the rest of the year. And I didn't say that a crash was going to happen in May or June. I was looking out toward the end of this year and 2027. But this is concerning, right? Because once again, we see a significant amount of selling. We see a significant amount of leverage leave the system, and then it just builds right back up. This is kind of how it works. You can't blink. Watch oversold levels, and of course, pay very close attention to weighted momentum in this market. That said, looking on top of that, our daily momentum signals, which we have down here in our CW anchor, are positive for the Russell. And on the S&P 500, remember, we don't really pay too much of attention to the NASDAQ because it's just a significant, it's just a repetition of the S&P in many ways. The EW score is negative to start the morning, but we are positive on the cap weight, which remains bullish. And the stocks that are breaking down, it's still a lot of the same problems in the market are persisting. Higher food price expectations weighing on margins, deeper concerns around real estate on all of the refinancing. Of course, the financials are under pressure, particularly the insurance industry. We continue to look at and witness what is transpiring there. And we're seeing a little bit of weakness to the downside on the refinery side. But it's all technology all day, every day on the on the S&P 500. Intel continuing its run. It's up about 25% in a week, 43% in a month. Keysight, KLA, SanDisk, Broadcom, all very strong momentum stocks, all with RSIs over 70. So be very, very cautious in that environment. If you're trading them, keep tight stops, pay very close attention to that 8-day moving average. All right. And then finally, last thing I will note, Ed Yardeni and Tom Lee both calling the bottom. I think this is important to note because these guys do act a little bit as a qualitative voice for the market. They do kind of they are like a little bit of an on-off switch. I know that Lee is following momentum in some capacity, and Yardeni looking at technicals, paying very close attention to that. So we've got a large number of reasons for this move. And once again, if you missed it, I highly encourage you to pay attention to our indicator. In addition to that, the 20-day moving average is a great place to focus on the FNGD, the FNGG, which is the positive bullish ETF for FANG stocks, and the FAZ. And the FAZ abated as well, right? That's the bearish ETF for the banking stocks. That broke under its 20-day moving average April 6th, same time that we saw momentum return to this market. All right, real quick, talks are alive. Iranian's financial minister told France that progress is happening on many issues. Trump's saying the right people want a deal. We're seeing supply rerouting. The IEA has warned about demand destruction spreading, higher prices and supply scarcity eroding demand, the U.S. blockade continuing, and Japan, right? The U.S. 30 million barrel exchange, Japan 20 days of stockpiles in May. This is a coordinated release of oil. We'll provide a little bit of support and buy some time. We're back under 100. I am not focusing or speculating in the upstream. I just continue to keep my focus on the midstream here in the United States. The one thing that we do have to note is that a sanctioned tanker did test the blockade. The Rich Starry is a U.S. sanctioned Chinese-linked tanker. It did sail out of Hormuz. It was sanctioned in 2023 for helping Tehran evade energy sanctions. It flies under the flag of a landlocked country, which makes no sense. The first attempt, they tried Monday. They turned back. They restarted hours later, passing through on Tuesday. The safety signal they transmitted to the Chinese owner and crew, which is standard mechanisms during a conflict. The second sanctioned tanker stopped off the Iranian coast after attempting transit, and it may have docked. Most reached by Bloomberg say they'll wait until the workings of the blockade are clear. But China's response, urging peace talks, only ending the war can ensure safe passage, said the Chinese foreign minister. All right, JPM beats, WFC misses, and Jamie Dimon warns. Okay, that kind of feels like we're seeing the same game over and over and over again. Dimon is warning about private credit, saying that losses are higher than the environment warrants. Regulatory intervention is coming, he is claiming. And once again, we do know that the Fed and the Treasury are analyzing and assessing what's happening with private credit. JP Morgan beat pretty big. Revenue up 10% on the year. Investment banking fees increasing by 28%, and they're trading up 20%. We saw that with Goldman, very strong trading revenues, but their NII guidance was cut by 1.5 billion. So the thing about this, real quick, right? The net interest income coming down. The market stock is down as a result. Very clear, delinquencies down, so that's positive for the overall market. For the consumer. Novo Nordisk with OpenAI, why not? Partnership for an AI drug discovery, stocks up 3%, but it's not a bank, but it is the biggest pre-market mover we're seeing. For the week, obviously, PPI today, J&J, Citigroup, and BlackRock earnings. We'll be looking at how we digest these JP Morgan and Wells Fargo markets or reports. Net interest income guidance will ripple, obviously, and Dimon is still warning about private credit. Don't be shocked if we move to overbought and then we start to see some selling as people start to warn about the same things that we've been warning about for 6 months. This is a very unique squeeze, and it does feel very comparable. This is a hated rally, by the way. This is very comparable to where we were in the summer of 2022. So we will look for the next rollover, and we'll just continue to ride the momentum and keep an eye on the FAZ and the FNGD. All right, everybody, that is that. I hope you all have a great trading day. I'm going to comb my hair now, and we will go from there. If you have any questions, obviously, you know what to do. Just go to the comments section, and we will keep on carrying on. Stay positive.